In geopolitics, there are no friends. There are only balance sheets. And right now, the biggest balance sheet in the world is bleeding out. By the start of 2026, the United States national debt smashed through the $38.6 trillion mark. But the number itself isn't the murder weapon. The cost of service is. Just the interest payments alone have crossed a crazy threshold, $1 trillion every single year. And right at this exact, critical moment, the primary sponsor of the American deficit, the entity that kept the lights on for decades, steps back and simply says, enough. China is dumping US Treasury bonds, the supposedly safest asset on the planet. Beijing's share of foreign reserves has collapsed to a miserable 7.3%, a low we haven't witnessed since 2001. Capital isn't just walking away, it's sprinting. It's fleeing to hard reality. Gold is shattering historical ceilings, momentarily breaching $4,800 an ounce. Silver is pushing hard toward the $95 mark. The mainstream anchors will tell you this is just routine diversification. Don't be naive. This is a geopolitical divorce, cold, calculated, and final. But here is the paradox. The real question that should keep you awake at night is China, the ultimate buyer of last resort, is systematically dumping American debt. Why have total foreign investments in U.S. government bonds suddenly hit an all-time high of $9.36 trillion? If the biggest creditor is walking away from the table, who is secretly buying Washington's IOUs? How is a tiny country like Belgium suddenly a financial superpower? And why is the smart money quietly bracing for a completely unexpected, brutal scenario in 2026? Welcome to Imperial Audit. Today, we open the shadow ledger. Let's look at the numbers behind this move. To understand the autopsy, you need to know how the patient lived. At its peak in June 2011, China controlled a colossal 28.8% of the entire foreign-held U.S. debt market. By November 2013, Beijing's portfolio was a bloated $1.316 trillion. The setup was perfect. China printed cheap goods, sold them for dollars, and loaned those dollars right back to Washington. Financial captivity, neatly packaged as global trade. But look at the data now. Accelerating after the sanction wars of 2022, Beijing executed a start, quietly cashing out. By December 2025, Chinese holdings shrank to a mere $683.5 billion. We haven't seen the ledger look like this since the ashes of the 2008 financial crisis.
But China isn't just moving to cash. They aren't stupid. In the financial reports, a very specific, massive figure keeps flashing in neon: $850 billion. Financial commentators think this is just a pile of dumped American bonds. The reality is far more cynical. That $850 billion, roughly 6 trillion yuan, is the exact volume of brand new special sovereign bonds that China plans to issue themselves over the next 3 years. They are redirecting the flow of the river. This capital is staying home. It will stimulate their own domestic economy and quietly swallow the hidden debts of their local municipalities. Even worse for Washington, an identical sum is now designated for overseas lending to the developing world. Think about what that means. China is engineering a massive mirror debt. They are resigning as America's primary sponsor and immediately stepping up as the apex creditor for the rest of the planet. While doing this, they are aggressively vacuuming up real, tangible assets. Chinese physical gold reserves have swelled to 2,305 tons. That's a stockpile valued at over $400 billion. They are trading paper promises for physical leverage. So, if China, along with Brazil and India, is dumping this debt, the market should be an absolute freefall. It should be a crater. But it's not. Total foreign investments hit that $9.36 billion record. So, who is holding the bag? Japan is sitting at number one, a $1.2 trillion portfolio. Over the last year, Tokyo grew their holdings by 11%, swallowing another $115 billion. But for Japan, this isn't dominance, it's a death trap. High U.S. interest rates, stubbornly above 4.5% on the 10-year, are violently crushing the Japanese yen. The Bank of Japan is bleeding out, balancing precariously on dangerously close to a currency collapse. The UK sits in second place, randomly bumping its assets by 16% to $888.5 billion. But the biggest joke, the ultimate enigma of this entire era, is Belgium. Investments funneled through this tiny European nation surged by a massive 33%. They added nearly $120 billion to the U.S. debt pile. Did the Belgian economy suddenly discover limitless oil? Of course not. Belgium is a ghost, a front. It is the home jurisdiction of Euroclear, the world's premier clearinghouse, the ultimate dark pool. This is where sovereign wealth goes to hide, in hidden plain. Through Euroclear, international investors, massive Middle Eastern sovereign funds, and very likely the commercial banks of China itself are secretly buying U.S. debt. They are hiding the ultimate beneficiaries. Think of it as a financial proxy server. When a central bank buys a treasury bond directly, its fingerprints are all over the transaction. The US Treasury knows exactly who holds the leverage. But when that same purchase is routed through a custodial account in Brussels, the trail goes completely cold. The ledger merely shows Belgium as the owner. It is a legally sanctioned blackout zone. They are building a financial bunker, securing dollar-denominated assets without exposing themselves to the geopolitical crosshairs of Washington's sanctions. Speaking of the Middle East, look at Saudi Arabia. In late 2025, they executed the largest single monthly purchase in their history, $14.4 billion, pushing their portfolio near $150 billion. They are quietly converting excess oil revenues into American financial assets. They are buying security guarantees with petrodollars before the music stops. Despite these hidden buyers, the fundamental architecture of the market is completely broken. In 2010, foreign governments, entities driven by geopolitics, not profit, controlled 40% of the U.S. Treasury market. Today, that number has dropped to 15%. The market has shifted. It has moved out of the hands of passive central banks and directly into the jaws of private capital and American households. And private capital does not care about diplomacy. Private capital demands a yield, and they absolutely do not forgive structural incompetence. Enter the bond vigilantes. It's an old term from the 80s, coined by Ed Yardeni, but they are back, and they are out for blood. These are massive, ruthless institutional investors who actively punish governments for reckless fiscal spending. When Washington passes new, unfunded tax relief packages, the federal deficit blows out to an apocalyptic $2.28 trillion. The vigilantes don't write angry letters. They execute. They massively dump long-term bonds, deliberately and artificially driving up the yields. The math is brutal. When the average rate on the debt hits 3.36% against a $38 trillion principal, the U.S. Treasury is forced to bleeding out $426 billion in a single fiscal quarter just to pay the interest. And this bloodletting doesn't stop at the steps of the Capitol. It bleeds directly into the real economy. When the 30-year Treasury yield pushes past the 5% barrier, it sets a dangerous baseline for everything else. Corporate debt refinancing suddenly becomes prohibitively expensive, triggering waves of bankruptcies for over-leveraged zombie companies.
Mortgage rates shadow the 10-year yield, meaning the housing market freezes solid as buyers are completely priced out. The vigilantes aren't just punishing the government, they are effectively suffocating the entire credit-dependent system.
The institutions are terrified. Moody's already stripped the U.S. of its final AAA credit rating, downgrading the sovereign to AA1. Analysts are stating openly, America is playing with fire, and soon the markets will simply declare this system to be terminal madness. This is where the Federal Reserve is dragged into the spotlight. On December 1st, 2025, the Fed officially killed its quantitative tightening program, having drained $2.2 trillion from the system. Now, in 2026, there is a new boss, Kevin Warsh, nominated by Donald Trump. Warsh has a mandate: stimulate the economy before the elections, cut the federal funds rate to a range of 3.00% to 3.25%. He advocates an aggressive, active wind down of the balance sheet alongside a frontal assault on interest rates. But here is the fatal anomaly. The trap is sprung. The Fed cuts short-term rates, yet long-term bond yields, the actual cost of borrowing, continue to climb, higher and higher. In classical economics, when the central bank slashes rates, borrowing gets cheaper across the board. But the system is fracturing. We're witnessing the brutal steepening of the yield curve. The market is demanding a massive risk premium just to hold American paper for the next 10 or 20 years. They are essentially telling the Fed, we don't trust your currency, and we certainly don't trust your math. This is a blaring siren. It means the market flat out does not believe the war on inflation is over. Billionaire investors are publicly stating the market is dead wrong. If the new administration rams through aggressive trade tariffs, the core prices of goods will explode. Inflation will return with a vengeance. For serious institutional money, this is the exit signal. The Danish pension fund, Akademi Pension, made the unprecedented move to dump all their holdings in U.S. government bonds. Their stated reason? Deep, systemic fears over the public finances of the United States. When trust in paper evaporates, capital flees to hard reality. This is exactly why gold is consistently closing weeks at historical maximums. It isn't a speculative rally. Gold has become the ultimate global metric of total distrust in the fiat debt system. So, is this the end? Are we looking at an overnight crash of the global financial system? Not tomorrow. What you are witnessing in 2026 is not a sudden explosion. It is a slow but massive shift. The era of blind global trust, the golden age when developing nations bought American debt without looking at the price tag, is dead and buried. The United States has been forced into a brutal new model: yield through risk. They now rely on private investment funds, offshore dark money, and captive political allies like Japan. But survival in this new world comes with a suffocating cost of capital. The risk-free status of the US Treasury is a nostalgic illusion. Today, Washington has to aggressively fight for global liquidity on an equal footing with Chinese sovereign bonds and physical gold. What does this mean for you? The rules of the game have changed permanently. Parking your wealth in safe government bonds guarantees nothing but slow, methodical depreciation. Inflation isn't a temporary glitch. It is the system's deliberate, calculated tool to melt away the debt burden. The smart money is moving. Premier investment houses like Morgan Stanley are actively ordering their clients to stay neutral on duration. They are pivoting capital into Treasury inflation-protected securities, TIPS, hard commodities, gold, and infrastructure equities. TIPS provide a mechanical hedge. Their principal value adjusts upwards precisely alongside the official consumer price index. It is a defensive perimeter against deliberate currency debasement. Meanwhile, gold requires no counterpart. It cannot be printed, it cannot be downgraded by Moody's, and it does not default when a government shuts down. It's the king of the jungle when fiat money fails.
In the year 2026, the US national debt ceased to be a bottomless vault for foreign reserves. It became a brutal, unforgiving battlefield for global private capital. The bond vigilantes are officially off the leash. China has executed its geopolitical Knight's move, and gold has proven, once again, that a multi-millennial form of money outranks modern paper promises every single time. In this high-stakes game of global liquidity, the music is slowing down, and there simply will not be enough seats for everyone. Ensure your ledger is ready for the storm. It has only just begun.